First of all, OC Gal, thank you for the $20 super chat. It means a lot to us. Thank you for sending that.
Yeah,
It
means a lot to us
on my channel. thank you for sending it to me. I appreciate that a lot.
I asked him, I go, why is your monetization on sharing? He goes, well, because I'm giving you guys some money. I said, that's not even a feature on YouTube. And then he goes, oh, wait, I'm giving it to the SpongeBob clip. Everyone got demonetized, and he's sharing his revenue with SpongeBob. Don't listen to his comments that he posts publicly about, oh, I didn't get demonetized. I don't know what you guys are talking about.
No, I know. When I posted that, I deleted that tweet because I thought I was legitimately sharing it with you guys.
Dude, a 1 hour tweet for like 40 seconds, and SpongeBob gets a portion of that ad revenue.
It was 15 seconds. It wasn't even... Well, we are here on SoFi Weekly, everybody. Thank you for joining us. Had an exciting week in the world of SoFi because Anthony Noto spoke at the Goldman Sachs conference. Let's start with Steve. You did an article on this conference. High-level thoughts after you heard the conference and Noto speak. What did you think about SoFi?
It was very interesting because all the suspicions that we have had, Noto confirmed it in this conference, and there were some points that he brought up that I don't believe were brought up on the conference call or in the 10K. Some of the things I found very interesting was that the amount of existing members who utilize Invest increased from 45 to 65%, and between 25 to 30% of SoFi's loans come from existing members. So that really shows that their top of funnel approach continues to work. And if you extrapolate those numbers out, and if they keep growing members at this rate, even if those percentages stay the same, it's going to make the aggregate of those numbers increase significantly quarter over quarter, year over year. And looking at this from a long-term perspective, that's exactly what you want. And on the loans, it's very interesting because SoFi really does seem like they're going to be able to eat everybody's lunch on the way down the way they're eating everybody's lunch on the way up. Because when rates decrease, it's going to put pressure on the traditional banks, whereas SoFi's spread is so strong that they can even just hold their APY where it is and still generate a good enough spread. And their long-term value is a 12-month payback cycle, which I don't believe they've said previously. Like there's a lot of good information in that broadcast.
It's crazy that like not long ago they said it was 18 months. Now they're saying 12 months. That difference in payback period is absolutely massive.
And payback period is how long it takes for customers to pay back the loan they gave out, correct?
No, how long it took
to acquire that customer.
Yeah.
Oh, to acquire a customer. Okay. Tevis, what were your high-level thoughts?
Stephen touched on it, but one of the more bullish sentiments that he said is that they're actually going to increase their lead once rates go down. And right now, the narrative is around, okay, well, SoFi has a really high APY, therefore they're sort of giving more of those benefits to their end users, whereas the legacy banks are not. And Anthony Noto, it was basically like, we have leverage because we have this integrated tech stack. We have better margins on our end that allows us to keep the APY advantage for longer so that when rates go down, they can still be extending that lead against legacy players. He also talked about a bunch of other things, and I'm going to jump around, but we can touch on all of these aspects. He mentioned the 12-month payback period. He also mentioned that they're taking share from the top 5 banks. So he harped on that point. He talked about the originations, saying that they're going to be about half of pre-pandemic levels or slightly under that in fourth quarter. So that's lower than we had expected for student loans. He talked about 2 billion plus in deposits this quarter, that he was confident in that. He talked about unit economics and how that's something that they're focusing on. And then he also talked about the contribution profit margin in the lending segment. He basically just guided long-term 70% contribution margin in the lending segment, which he talked about the SoFi Stadium and the reasons of why they bought that, and just the impressions that they got from these primetime games, the ad spots, essentially, the amount of times SoFi's logo was shown, it just was beneficial. And then the average direct deposit members holding 20K in their SoFi accounts, that was a statistic that also surprised me. And then I think the last sort of statistic was around that financial services productivity loop, basically the highest utility accounts being Relay and SoFi Money, and then the bottom of the funnel being lending, which is what we would expect. And then the 45 to 65 for existing members.
Yeah, and the other thing that he hit on was the RFP process seems to be very engaging because they are still in talks with a lot of big banks, and the cross-selling is certainly there because the big banks didn't even know about the capabilities of Galileo. And in at least one of the RFPs where they were discussing their capabilities, they were very interested in some of the processing aspects from Galileo. So it is very interesting from the tech side. And when you look at what can give SoFi a hybrid valuation between a financial company and a tech company, is that tech platform. They're building it out. And if this can become a annualized $1 billion segment, because right now it's about 350 million, that just means that they are generating incremental revenue from the competition, and this can continue to grow. And once they sign some large clients onto this, it could be a snowball effect into this. And that's where we can really give them a tech valuation, because if this, let's just say hypothetically in 2030, if tech is generating $3 billion worth of revenue a year, right now the contribution profit is slim, but that could easily go to 500 million or $1 billion on those numbers. And that's just reoccurring revenue outside the financial products. And then when the street sees that and analysts see that, and that is generating down to the EPS line. I don't think that this is going to be something that just trades in tandem with book value. This could really get a hybrid tech valuation, and there is no other fintech company that I know of that has that capability, because SoFi still to this day, out of all the research that I've done, is the only one that owns the back end the way that they do. I mean, JP Morgan, who has all the money in the world, writes blank checks for whatever they want. They're outsourcing the thought machine for their cloud services. So this is a very interesting aspect.
Even if we do stay around book value, we're still growing at such a high rate that the stock price would evidently still be going up by, let's say, 30% per year. So even if it does stay near book value without any multiples, that's still somewhere where I'd want to be. The multiple expansion would just be...
Same here. I'm just making the point that that's what could drive a tech valuation out of it.
Yeah, definitely. And then to the point for from Tevis, the contribution margin was no surprise. You just take the revenue from lending and then look at what their contribution profit is, and roughly about 70%. It's the guidance that he said. He said we don't see that going down. If we can find areas where we can increase it, then we're going to try to hold it at a higher rate. It's like 70 is the base and 70 plus is the option. There's no real pressure on the downside as far as what they can see. I think that's really, really enlightening.
So he talked about the 70% on the lending side as a goal. He also talked about 20% contribution profit margin for the technology platform. So the technology platform it's going to create a moat for the business. And I almost see the technology platform as this necessary factor that will propel their other businesses as a result of that relationship SoFi and Galileo have together around owning the full tech stack, because of that upside that I previously mentioned on the APY when rates start to fall. Anthony Noto mentioned the competitive advantage comes from having origination products as well as deposit products. And as a result of that, people can't really compete. And so on the tech platform, even if they have slower growth, let's just say, and if they have 20% contribution profit margins versus the 70% on the lending side, the tech platform itself is the secret sauce for their other B2C segments.
So I just compiled all of the web traffic for SoFi, Robinhood, Ally, Upstart, Lending Club, Nubank, Venmo, Cash App, PayPal, Chime, Coinbase. Robinhood, maybe not as good as some people would like. A little bit of a downtick on Robinhood.
Oh, damn. Look at SoFi.
But SoFi continuing to climb. Strong numbers from SoFi. Great numbers from Ally. Upstart doing way better than I would think. They're crushing it here in August. Lending Club, no good. Nubank, I mean, is there anything else you'd expect? Venmo, great. Cash App, really, really disappointing. PayPal holding up these great numbers for Q3, both July and August holding up amazing numbers. Chime doing pretty well, and Coinbase, I mean, they're Coinbase.
The main outlier to me is just how much bigger PayPal is than literally anything else on this list in terms of website traffic.
don't forget, whenever you were talking about PayPal, you also have to include Venmo as well. So things are doing well. And like, look at this though, Venmo comparatively to Cash App. Like, I mean, one's growing, the other one's not right now. So, and it is just website traffic. You know, a lot of, you can see a lot more usage for Venmo on web.
Great usage of that stock-based compensation. Great usage.
Look at SoFi over the past, 5 months, continuously just ticking up higher and higher and higher, where across the board, you can kind of see stagnant results. I mean, yeah, Venmo is kind of just up and to the right. Nubank's up and to the right. SoFi's up and to the right. Happens to be the three maybe most exciting fintechs for me. But
and we're just going into football season, so it would be nice if we see this hit 15 by sometime in Q4.
So obviously SoFi went from 11 million visits in April to 13.78, hitting almost 14 in August. Anyone want to give any thoughts on the SoFi Stadium?
Actually, looking at it now, the price we paid, which I think is a little less than 20 million a year, if I remember correctly.
Noto inferred that they were spending roughly that amount sponsoring events such as US Open, a golf tournament, X Games, and some other things. And it was bringing in a fraction of the views that the stadium naming rights, if they get 4 primetime games a year, is going to bring in. So just from a allocation, if you have an advertising budget as part of your expenses, and you're going to spend that money either way, this is a brilliant move because you're getting the most bang for the buck. It's already figured into the expenses. This isn't a sham, and it was a great move on their part. And now you got World Cup that they didn't foresee. You have opening ceremony of the Olympics, and what was it, 6 shows of Taylor Swift eras?
Beyonce's there right now in August, and then I think
Wait, who? Yeah, who's there, Tevis?
Beyonce.
So I have a question for everybody. If Taylor Swift was a company, what would her market cap
be? You heard Beyonce from
Beyonce is there.
Could you imagine?
Can you put up Kelly's comment just a little bit above there? Yeah.
See, we're not the only one, Tevis. I mean,
it happens.
You said, I think you're trying to cover for it, but you said Beyonce.
Clip it. This guy's a meme warehouse. He creates memes.
So going back to SoFi, somebody left a comment on my article that was quite interesting that I never thought of. What if SoFi acquired WisdomTree?
But would that give them any more knowledge?
Okay.
Oh.
How much would WisdomTree even be worth? I don't know. How much
their market cap is like just $1 billion.
I don't want them anyway. What do you want? Some crypto ETFs? What do you want?
WisdomTree has some pretty popular ETFs.
Maybe.
You want SoFi to buy a company for $1 billion because they have ETFs?
No, that I didn't say that I want them to buy it. I said somebody left a comment on my article that they should, or maybe it was asking if I thought that they would. But I started thinking about it. I'd have to do a lot of research on WisdomTree, but something like that would be an interesting acquisition if they did it for stock and didn't pay cash, for the simple fact that it could jumpstart a wealth management business.
What I'd be really excited about in terms of acquisitions is just waiting a couple more quarters till SoFi is starting to become get profitable, and then they acquire Lemonade, and boom, they're back into the losses again. And then I'd be buying more shares. I think that would be a fun one.
Then it'd really trade like a tech company.
yeah. The multiples would go down continuously. But honestly, I do kind of like, I'm not a shareholder of Lemonade right now, but I do like the business overall. And I do think they're getting stronger each quarter. And it's just a matter of, it's just a long period until they're going to be making some money, probably like 2026. So it might hold SoFi back from some profits, but I do think it's a very cheap company for how much we could cross-sell into additional members already. And I'm talking about insurance. If anyone doesn't know what Lemonade is, I'm not talking about a stand here.
WisdomTree reached 97.5 billion in assets under management this quarter, and it looks like they generate 313 million in revenue. It's interesting. It's $1 billion company. It's profitable. Net income's 123 million. So great margin, great margins. Interesting concept. And it completely jumpstarts that line of business.
Yeah, I think the question is, can they start a wealth management division or branch without an acquisition? And I think the answer to that is a definitive yes.
I think they can. It's just, does it make sense to buy the revenue and net income and the current ETF following that they have and whatever accounts they have? I don't know. I'd have to look into it.
They're not going to be in a rush to make any other acquisition, especially after Wyndham. I think that they're like, you had what, Technisys and you had Galileo in like 2019, Technisys in 2021.
Yeah.
And then you had Wyndham.
We're due for an acquisition.
We're absolutely not. Well, you just had one 3 months ago.
Just acquired Wyndham.
Had one. It was a $60 million deal. This was nothing. It's time to go back and get another billion in there. Lemonade. Yeah. Let's do it.
I mean, look, no, forget about Lemonade. Yeah, I mean, look, I'd be okay with dilution to get something like WisdomTree because it is profitable.
I mean, considering the fact that we had app downtime this week, he probably should be selling because he's going to get his ass fired.
Oh, we should talk about that. We should address that.
It wasn't even their fault because I'm pretty sure a lot of them crashed. Like Fidelity crashed.
Fidelity crashed too?
Robinhood saw, so a bunch of people came at me about this tweet. Cash App and Square crashed. Now, to be fair, Robinhood showed large amounts of outages for like an hour at 12:30, same day. SoFi was down all day. It's apples and oranges, the two of them.
In their defense, SoFi support was really on it on Twitter, just responding to everyone. And like that response, like app crashes are going to happen from time to time, especially if it wasn't isolated to just SoFi. The fact that their support is more responsive now, I think is also like a good thing because they haven't always been that way.
Okay, let's transition to this. Steve, I have a question for you. At the end of this article, you make a claim. I am looking forward to the Q3 earnings release, and I still believe shares can reach 15 by the end of the year.
So first, my track record is halfway good considering I said it's going to get to 10, and it did.
That's true.
And I'm increasing since it hit 10. I'm saying it's going to hit 15. I could be wrong. Earnings are in early November. We saw the bump go to like 11:30, 11:40, that area after Q2. So I think the combination, if we get a triple beat, good commentary about student loans, and then if we get a guidance increase, which we've already gotten 2 for 2023 fiscal year, this could be a recipe for upgrades going into the end of the year, because I still think this is a multi-year bull market cycle. I don't think it would be crazy for it to hit 15. And think about this. Noto purchased shares at $14 a share, 4 blocks at I think 71 or 7,200 shares a block in 2021 or 2022. Back then, he obviously thought it was worth at 14 a share, if not more, because he thought it was undervalued there.
Since we're on the topic of the buying and selling of the stock, there was actually 2 pieces of news this week around a big sell and a big buy. Do you guys know what I'm talking about or no?
Jeremy Rischel or whatever?
That was the sell. Which one was the buy?
I don't know. Who was the buy?
Oh, yeah, I do. Wait, Thomas Carper.
Yes.
Who's that?
And not a big buy. I mean,
well, okay. Just, you know what? Like, so Amit, if you throw this up, this was Unusual Whales reported that this senator that sits on the finance committee that's going to be discussing one of the student loan forgiveness bills. It's on the floor of Congress right now. He just bought a bunch of SoFi.
You could see between $1,000 and $15,000. It doesn't matter.
That's not a lot at all.
It doesn't matter. It's the fact that he bought it.
Yeah, it's just a regular guy buying shares in a company that he believes will benefit from student loans coming back.
And then the CTO sell is this other tweet, Amit, if we want to touch on that.
Why do you think the CTO keeps selling shares? He is uncomfortably bearish on SoFi.
He's not bearish. He's who knows.
Dude, he sold like 1/3 of his fucking position, his overall stock. Like, that's not cool, my guy.
I think when institutions buy and sell, it tells me more than when some tech guy buys and sells a stock. Maybe he wants a bigger pool. Who cares?
Look, I don't think it's a lot of shares. I get it. It's just annoying at $8. Like, that's where you're gonna sell when it could be 11 or 12 off one good gap profitability quote. You can't wait just a little. It's just weird, You're telling me you don't know any C-suite executives that try to time the market constantly? It's like these guys aren't oracles. They just have high-ranking positions.
For hundreds of reasons. People buy for one reason.
Yeah, and Anthony Noto is like the only executive that's been buying. Like Lauren Stafford Webb has also been selling stock. This guy's also been like pretty much a lot of their executives have just been selling stock for personal reasons. Like, I want to buy a house, whatever. I'm going to sell some stock.
And that's normal.
The CEO
It is normal. I'm not saying it's a bad thing, by the way. I'm just saying it's a little weird. I don't think it matters. It's just because this guy sells a lot. Like, he was selling at 6 and 7 too. It's not like he's freshly selling right now.
Yeah, look at what Throwable said. He sold a lot more at $5 a share,
which is worse.
Yeah, but it's not fine. He was wrong.
I know. That's true. Yeah, I mean, look, the Pounter insider sold a shit ton of shares last week as well, and like, so it's annoying. But at the end of the day, they all have.
Yeah, but okay, you can't fault people for selling shares in that capacity for the simple fact that they were given those shares as part of their compensation over the past 20 years. A lot of them, they finally have an opportunity to sell. Yeah, it's normal.
I get it. No, it's not bad. It's just you would think there's some catalyst where they would want to wait, but it doesn't necessarily signal they know what the stock's going to do.
You don't know if they were foregoing certain things that they wanted to do because a lot of their capital is locked up in that. I mean, look, I would rather see insider buying, but when you're private for that long, I expect executives to reap the rewards of their hard work.
I don't think Anthony Noto could sell shares in the public market and get away with it from retail.
Well, of course not, because he is like now weaned retail and like just trained them to respond to his consistent buying. And this is why, you know, it was amazing when he bought back in the absolute dip on, when was it? December of 2022. Yep. And then he bought again on the other absolute dip in March of 2023. Both times were when it fell to like 450. And investors were saying, that's amazing. But then he was also buying at like 14, 13, 8, 9, 7, 5, 6. And so...
so here's the question. At what price would you be okay with Noto putting out a 10B1 where he sells?
After any of the RSUs hit. He's got to get to one of those numbers.
So it'd have to be $25 then, basically, is what you're saying.
Yeah, I would think so. I mean, look, the guy can sell whenever he wants to sell. There's no question about that.
He could, but how do you think retail would take if he sells at $8?
I don't think that it would go over well with retail, as Tevis said, unless it is an RSU number, because those are the projected guidelines that he's going to get the additional comp on.
And besides, if he's the guy that's publicly saying that we're going to be a top 10, not if, but when, and, you know, we're going to have this like $100 billion market cap, so on and so forth, and then he's selling stock at like $8, then that's obviously like there's a what is it called? Like a cognitive dissonance there. He's basically doing one thing and then saying a completely different thing. Retail is going to see right through that, right? Especially because he's been reinforcing it through buying.
I think he's made a fortune through his Twitter share sales, if he did. I think he did because the purchases that were coming after that came up were 10 times larger than his purchases that came prior. So he definitely fell into some money. I'm honestly not too perturbed by these sort of things. Like Jensen just recently sold. I mean,
no NVIDIA shareholder should be mad at him for selling shares. The guy made you a fortune.
Like all these executives sell shares. It's a part of their savings account. This is where a lot of their savings goes, is into this bankroll of this company. Of course they can use it.
Look, I think we're headed into a multi-year bull market, and there are some reasons why. So first, this is a chart of the S&P 500. Since 1973, markets only declined for 2 consecutive years twice, and each time it's rebounded with 2 positive years. People continuously talk about the inverted yield curve. So here is the actual inverted yield curve. So the top graph is the 10-year bond rate versus the 3-month spread. And the gray lines here are the recessions that have come right after it. And the bottom is the probability of reaching recession and showing the spikes of that correlates with the inverted yield curve. Now, there is one period since 1960 that this did not happen. 1963, you had an inverted yield curve, you had the probability of recession spike, and no recession came within that next year after. And most of the time it happens within a year, not at the year point. It's very close after it inverts. Didn't happen in 63. It happened, it's 67, not 63, my mistake, 67. Happened after the 1970, after it inverted again. We could very well be in that position again. And remember what these charts look like. Every time that we have been there, unemployment has gone over 5%. Every time. unemployment is like 3.7, 3.8% right now. If unemployment doesn't get to 5%, I don't think we're going into a recession, because people need to stop thinking about paying everything with cash. Money is still going into the system. We still have a growing economy. GDP is supposed to be off the map this quarter. In order to technically have a recession, you need 2 quarters of negative GDP growth,
which we had.
As long as people can service debt and even pay down their credit cards a little bit, their credit cards don't have to be at zero. And with business earnings looking to expand, and then you go into a Fed environment where the Fed is cutting. Do I have that here? You have the St. Louis Fed projecting rates are going to go to 4.6 in 2024 and then 3.4% in 2025. The Fed uses rates as a lever when growth slows to stimulate the economy.
Correct.
But in an economy that doesn't necessarily need to be stimulated, that is growing, lowering rates is going to intensify expansion, because when you lower rates, the cost of capital declines. When the cost of capital declines, businesses are more likely to expand. They are more likely to take loans. They are more likely to expand into different areas, make acquisitions higher, because the cost of capital is cheaper. They can issue long-term bonds at a cheaper rate. They can take on debt in other areas at a cheaper rate. And what else happens? Credit card rates go down. Personal loan rates go down. Mortgages go down. You're going to see the housing market come back. It's money going into the economy. It's people having the ability to spend, being able to pay off their liability.
Yeah, but you're just making a generic argument for why interest rates going down is good for the economy. My question is that when they come down, it's typically because the Fed needs to stimulate. So what is the retort against why the necessity to stimulate will be offset by the expansion of the raising of the rates?
Well, it's not necessarily going to be offset. And you're right that when the economy slows, the Fed typically uses this lever because it's their only lever to stimulate the economy for the reasons that I said. But in an environment where the economy is already strong, it's only going to intensify, because right now
that's the question. How do you know the economy is going to be strong in 2024 when the Fed cuts? Because if it's a strong economy, then the cut will make it stronger.
You don't have companies tapping debt markets at the rate that they were previously. And when you look at the rate of debt and companies issuing bonds, when you have lower rates, it increases. And that normally comes because they need to make capital investments. They have a lot of money going toward CapEx, and that money that's going toward CapEx is money that's going to goods and services from other companies, which allows them to expand. So you're going to have even more job creation. You're going to have companies making more money. This is going to help earnings increase for public companies, which is going to drive the market higher. Unless something drastically goes wrong, we are probably setting up for a multi-year bull market.
It all rests on inflation also coming down, right? I mean,
which we have a problem right now. And this is something that can derail it. Energy is a very serious thing. And I am not against solar and wind. The answer is everything ex coal, my opinion. So let's just be very clear about that. But anybody who thinks oil and gas doesn't drive the world is crazy. It's not just about an energy source. It's the number one feedstock in manufacturing. When oil is at $90 a barrel and increasing, it hurts companies and it hurts consumers, because it's a silent tax on goods and services. Because if you think about plastic, natural gas is the number one feedstock in plastic. I mean, it's made from hydrocarbons. Most abundant thing of hydrocarbons is oil and gas. It's not a hard concept. The pacemakers, keyboards that we're using, computer frames, everything is made out of plastic.
Do you agree with his thesis about this multi-year bull run?
Absolutely. I've been saying roaring 20s is going to be a thing for a while now, but mainly on the idea of, similar to what Ark is saying, that innovation is just coming in so hot that it's going to be forcing this. I think that macro Steven is my favorite Steven. 1,000%. I was simply a viewer in that moment, just listening to you. Yeah, no, I think he's spot on. And I think that we're absolutely going into a bull market. And in a big one. I think one like roaring 20s level. I think AI is a big part of this. I do think that solar and wind do play a big part, at least, and that's from a very uneducated point of view. But
they're going to. There's no question. They're going to see the most expansion from here to 2050 from a total consumption aspect. But you still need a abundance of oil and gas, and we are still at a net deficit from the amount of gas that is produced to consumed. And that's not good, because when Saudi Arabia cuts and then we're producing less, and I am expecting, I haven't seen the numbers, but I do look at the drilling rigs from Baker Hughes and everything else. When we are producing less oil and gas, we're the number one oil and gas producing nation in the world, or at least we were last year.
Yeah.
When you combine that with Saudi Arabia and OPEC Plus cutting barrels and taking supply off the market, it makes energy prices go up. When energy prices go up, your cost of manufacturing increases. And that becomes just a tax that goes on to the end user, because companies, they're not going to eat it. So they jack up prices a little bit to offset it. You need oil and gas around $60 to $70 a barrel. I'd love to see 50, 55. I don't think that's realistic, but 60 to 70 is that sweet spot where oil and gas companies make money. Consumers don't have the type of inflation that we have now. We saw it coming down. We saw inflation coming down when oil was in the 60s. Now oil's back up. WTI's, I think, is at like 87 and Brent's around 90. If that stays like that, we could see inflation reverse up, and that could cause the Fed to hike rates again, which would not be good.
Thank you, everybody. We'll see you next week on another episode of SoFi Weekly.
Thanks, guys.
Bye, everybody.